Ridham Desai, Head of India Research, Managing Director with Morgan Stanley India, joins us now. Ridham, fantastic to have you back, and thank you for joining us. We've got some special augmented reality graphics which will just come up on your screen, which will just crystallize the theme of your report. But before we get into specifics of the report, how are you feeling about markets? 25% up this year, and then a little bit of underperformance. That's par for course, right? We should not worry about anything.
No, the market is underperformed. The EM index is up a little bit more than India. China is up 40%. India is up 20 actually in dollar terms. So you're looking rupee terms, but dollar terms is up 20%. I think the reason it has underperformed is that we went through a soft patch in growth. And I think the market started anticipating this soft patch way back in April. So that's when India started giving up relative performance. We didn't get to see it here because the emerging market rally has been very strong. So obviously in absolute terms the market didn't actually come down until EMs started to a little bit correct. So I think we are done with the soft patch actually. I think the worst was probably the June quarter. And we should have started a recovery with July, and as the data comes in, I think it will be quite visible that we are now back on track, which has been something that I think people were already anticipating, and surprisingly the market forgot that in May and June people were really worried about GST, and the forecast for GST were far worse than what we actually got. GST has been significantly smoother than what we were all anticipating. So I think that's good actually. We should be done with this.
So you're saying all the concerns around the economic slowdown, the fact that earnings have still not come in, they're not as real or not as gruesome as some experts are making it out to be?
No. The facts are that earnings have slowed down, but we are in a recovery that started about 6 quarters ago. We got 2 blips in that. We got the Demon blip, we got the GST blip, and particularly if you ignore the GST blip, actually revenue growth is at a 7-quarter high, and earnings are already accelerating. So margins have just started to expand. So I think you will see that revert in this quarter. So I am fairly sure that we are in a new earnings cycle. It's been a slow, steady one, not like the V-shaped one we saw in 03-04, and therefore this has been the longest bull market in India's history, but also the slowest one. I marked the bottom in March 2009. After that, the Nifty has made successive highs and successive lows, higher tops, higher bottoms, as technical analysts will call it. Nifty was 2200, today it's 10,000. It's already been a 5-bagger, and I think it's got another 3 to go.
But just in the short term, Ridham, don't you think that with what the RBI said yesterday, they've revised the GVA number downwards to 6.7%. Now I know for some between 6.5% to 7% is great, but for a lot of market watchers, 7% becomes a pivot point for the market, so to speak, from a growth projection perspective. Do you think that there was some disappointment on that front, where people will start reworking their earnings forecast also lower based on what the projection is, even though the Prime Minister has defended that mark, saying by the end of the year we'll recover? No,
so Tanvi, that was a mark to market. If you look at the number, it actually embeds an acceleration in the second half.
Yes, that's right. In the fourth quarter, we'll do about 7.7.
So there is an acceleration. So that's what I'm referring to. So there's a mark to market, which is that the second quarter turned out to be worse than what everybody was expecting because of the inventory drawdowns that happened. Now the inventories have refilled. So I would not worry too much about it. I think we're in a secular growth story in India, give or take a few points here and there. 7% GDP growth is where we see it in the next few years, and I think we should not expect it to be much higher than that. For that to happen, I think we need significantly more infrastructure investments, which may come, and that's our bull case, but I think the base case is we get 7% growth.
Okay, now let's look at the special AR graphics which we've made, and this is just part of the Morgan Stanley report authored by Ridham and his team, as to what the India projections are, what the GDP forecast are, what their Sensex targets are, and this is again, we've taken the most optimistic scenario here from 2017 to 2027. According to Morgan Stanley and Ridham team's projections, the economy could be 3x. So if the economy becomes 3x, what will happen to the stock market? What will happen to India's GDP, and where earnings are likely to move? All the data point will just come up on your screen. That's the loan to GDP ratio, and that's likely to improve, which means they're expecting that Indians would lever the balance sheets, corporate leverage would again start. Now this is the most interesting one, where according to Morgan Stanley estimates, the mutual fund AUM is likely to significantly increase. Perhaps they are referring to the fact that Indians would be migrating more towards financial savings. They will move out of gold and they will move out of real estate, which already has started. That trend I think is clearly visible, but I think Ridham and his team are making a case that this trend will only magnify going forward. And the market cap to GDP, even if you assume that the stock market trades at at a ratio of 1, that means we are looking at Nifty multi-bagger ho sakta hai. That's the bottom line. 3x is a multi-bagger.
Yeah, so Nikunj, I'll say something here is that markets are non-linear, as we all know.
Of course.
Yeah, so there's no genius in that. So even while the GDP grows to 3x in 10 years, I think the market will do it in 5.
Okay.
Okay, so our projection is that the market does 3x in 10, but inside that we have a view that most of those returns, 90-95% of those returns come in the next 5 years, and then we'll enter a bear market.
Are you just boycotting all the global concerns?
No, I'm not. In fact, that's
something would haunt us big time.
That's the biggest caveat. So that's the biggest caveat. I think so far the signs are that 2018 is okay.
Okay.
Second half of 2018, maybe fourth quarter of 2018 is when we may start seeing the first signs of a global slowdown, which may then probably start accelerating in 19. However, if that happens earlier, then there is a risk to this story. Overall, on a more medium-term perspective, the fact is that India will not be benefiting from strong global growth like China did when it did its 10% growth. The global growth average was around 4.5-5. The likelihood is that we are now at 3.5. So we are suffering from that headwind, and it's unlikely to go away because global debt, global demographics all are actually against acceleration in global growth. So that is why India doesn't actually go much faster than 7%.
So you said 2018 we're going to have a global economic slowdown. What's going to lead to that?
No. I didn't say. I said it is likely that in the fourth quarter we may see the first signs. When that's not our base case view. Our base case view is that we are in a pretty healthy global growth situation.
That's
right
a risk you think which can
That's
pop
a risk,
up.
yeah. That's
Right.
a risk that we have to worry about.
What would lead that?
See, I think it is likely to be inflation because that will then mean that central banks have fallen behind the curve and will get rate hikes, which will be accelerated in nature, and that will spook equity markets and it will also hurt global growth. It may also be because leveraging accelerates a lot faster in the next few months because interest rates are pretty low even now, even after the hikes that have happened, and real rates are in negative territory in most part of the Western world. So it does promote a bit of leveraging. So it's been a slow recovery out of the 2008 crisis, but it's been a steady one, and global growth is actually doing quite okay. You can see that in the trade data. So Korean trade data last month hit a multi-year high, and we'll see it in the Indian trade data when it comes. You'll see very strong exports from India, and likelihood is that imports also in India are accelerating. In fact, if there's one indicator that you should rely on when you're looking at the macroeconomy, because the domestic indicators tend to be very noisy, look at non-oil, non-gold imports from India. That has been in this type of a recovery. It had a bit of a soft spot last quarter, but it's now coming back. And that is telling you that the domestic economy is actually doing quite okay.
Do you sense that we're headed into that frenzy sort of state from now up until whenever that slowdown is going to come in? Because
in the world or here?
No, here in India. Because
No.
suddenly everyone's realized,
No,
oh my
Aisha,
God,
where
we start on
frenzy?
the best of the bull run. No, there'll be a massive catch up.
There's no frenzy at all. Okay,
I'm not
let me
saying
just
now.
tell you why.
Will it happen?
Okay, we'll lay down the metrics to track.
Sure.
So what I look at is price to book, because earnings have got a lot of cyclicality to it. So bull markets peak with peak earnings and peak multiples, right? We're not there right now. We're at trough earnings and rising multiples. So the best way to look at this is to look at price to book. So this is the price to book range that India has followed over the last 25 years. At the bottom it goes to 2, at the top it goes to 5.5. Where are we right now? 3. Where's the frenzy? There's no frenzy. It looks on PE multiples because earnings are very depressed. The profit share in GDP has collapsed to multi-year lows.
3%.
And liquidity is very strong.
And that will actually recover in the next few years, quite sharply actually, which is why I think earnings may compound at about 20% in the next 5 years, and stock prices will do the same. If you take a 20% compounding, you get to almost 3 times Nifty from here in 5 years. So Nifty has to only track earnings, and without any multiple expansion, you'll still get there. the likelihood is that you'll also get a multiple expansion. So there is a possibility, and that's our bull case, that we underestimate the bull run that comes. Global markets, I'm not so sure. We still don't think it's a frenzy, and our US strategist is quite constructive on the Dow. So he thinks we are hitting higher levels in the next couple of quarters. And so
as
far
is
as
the rest
that,
of the world, everybody.
yeah, so far as that remains, I don't think the Nifty is going to correct in absolute terms in a major way. 5% correction here and there will keep happening.
You know, I have a simple follow-up question. If I look at India's GDP growth in nominal terms, I think for last 7 or 8 years, we've had double-digit growth in nominal GDP for India. But that has not translated into very strong absolute earnings. You know, 1 year it is pharma, 1 year it is IT, 1 year it is oil marketing company. So do you think we should stop getting obsessed with what the Nifty earnings picture is? You know, markets are obsessed with Nifty ka PE, total aggregate Nifty growth. Do you think that's the wrong way of looking at this market?
No, it's not. It's not. But Nikunj, you made a very important point in your question at the start. So nominal GDP growth is actually not accelerating. Even in your 7.7% number, the nominal GDP growth is around 11.
Okay. Yeah,
And it has been
it has been there, but you didn't get earnings growth because earnings don't depend just on nominal GDP. They depend on a few things. If I were to simplify it, they depend on the mix between real and inflation. So in the last 5 or 7 years, forget the last 2 years, prior 5 years, you essentially had high inflation, low real growth.
Yes.
Okay, that's not a good mix for earnings. Mix for earnings is slightly lower inflation, higher real growth. The other way to look at it is that earnings depend on the mix between investment and saving. Now there's a big shift happening here, which is in the saving pool. Households have moved away from physical assets to financial assets. And that is a very sharp move. And in fact, I think we're just at the start. You know, picture abhi baki hai. $4 billion we got into mutual funds in August. I think the September number is going to be pretty strong. And we're just at the beginning of what's going to be a secular shift into household in financial assets. So households are just about tasting the joy of holding on to financial assets, which is every month you get an yield. Unlike gold, which sits in your vault, costs money to save, and doesn't produce anything, and you have to wait for the price to go up, and that doesn't happen always. Like people have discovered in the last 5 years, gold can also go down. Okay, so that you know, households in India are discovering now, supported by a very constructive policy environment. So unfortunately I missed the Prime Minister's speech yesterday, but one of the most important changes that they've made in the last 3 years is that they've forced provident funds and the national pension scheme to invest in equities. This is like the 401k moment. 1980 it was, exactly 37 years ago, that America had 401k. At that point, people didn't realize what that was going to do to US equity markets, but following that, we had a secular bull market in America because savers in these pension schemes and in these provident funds come every month and put money. They're going to be net buyers, they'll never be selling. For the next 30 years, they're not going to be selling because only net flows into them. And what you're seeing today is the domestic mutual fund story. What has not been covered in either the press or in the popular narrative is what's going to happen to NPS and PF. It's going to be geometric progression. Those assets will become so large, which is why one of the forecasts in our report is that ETFs in India, because PFs are investing through ETFs. ETFs are going to grow. You know, they were like $6-7 billion. They'll become $200 billion.
Exponential growth.
30x growth. Sorry,
No,
Tanvi, you were trying to ask something.
So do you think that this is what we are experiencing right now is like the 1989, you know, the cusp of the bull market that we witnessed in the United States, which lasted like 12 years. Are we at the start of that right now? I mean, are you going to make that comparison?
We are in that.
Okay.
So it's not the start because
not.
I think it started a few years ago.
Okay.
It's been slow and therefore it's not been felt like a bull market because we got used to the 03-08 bull market, which was a very rapid rise in the index. The index went up 7-fold in 4 years. So that's not the type of bull market this is. It's one which really makes you work hard. It causes you to sweat because it doesn't actually give you quick results. And I think it will progress in a much faster fashion as we approach its end, which is probably another 3-4 years away.
I just had one more question on, you know, you said that exports are going to come back in a big way. You know, when we're looking at the trade data, that's where the cue would lie. What are you picking up on the exports front? Because so far the sound bites that we keep getting are, you know, that export slowdown is hitting us hard, the rupee appreciation is bad for us, and, you know, which is one of the reasons why the government is on intervening in the fall of the currency. So what are you picking up on that trend?
So on a relative basis, our exports are lagging, for sure, right? But on an absolute basis, they are still going up. So again, this is about relative and absolute, which is on a relative basis, Nifty has lagged the EM index, but on an absolute basis, it's still going up. So global growth is supportive for better exports. I would suggest that manufacturing exports will actually do quite well. And some of them have already started doing well, and you'll see the numbers in the next
But isn't this about competitiveness? Isn't this about gaining more market share on the global platform, right? Unless India does that with a competitive currency, we won't be able to support our growth as much.
So Tanvi, again, how do you judge whether the currency is overvalued or undervalued? Okay, and there are a lot of models out there. The RBI uses the real effective exchange rate, where it adjusts the nominal currency for relative inflation differentials. But the real story for me is, where is your current account? If your current account is surplus, which means you are saving more than investing, that tells you that the currency is overvalued. Our current account is in deficit. So our currency is not that poorly positioned as people want to make it out to be. They are looking at the absolute number. That's the INR USD cross. That tells you more about the USD than it tells you about the INR. Or let's put it tells you 50% of the USD. So if the USD appreciates, the INR will depreciate. Does it mean that the currency is gaining in losing ground? We don't know. We don't know unless we see the trade data. Okay. The trade data actually exemplifies this much better.
I have a very simple, follow-up question. I will move away from currencies and macro. If I look at the growth in airline traffic, it's 20% every year. That means the industry is actually doubling in about 2.5 years. Car sales have been breathtaking. Two-wheeler sales are making a comeback. If I look at the economic backdrop, job creation is a challenge. It's not that everything in the consumption space is looking strong. Volume growth, which FMCG companies are reported, it's hot and cold both. So where is this demand coming from? Is this Indians are getting more lever up, or this is demand which we've not discovered yet?
Okay, that's another, I think, excellent question you've asked. There are multiple dimensions to this.
Because I'm just wondering
multiple dimensions. So first is what's happening on the consumption basket. So India's per capita income is rising. So we're at $1,700. Our report suggests we'll be at $4,100 in 10 years, which is high middle income. But this transition happens, food loses share. We are a poor country right now. 60% of what we consume every day, 100 rupees we consume, 60 rupees is food. But as we get richer, the share of food falls because there's only that much food you can consume. So it tops out at 60. So when your consumption goes from 100 to 110, that 40 has grown to 50. That's 25% growth. So that's the first story. So you have nominal income growth, which is about 10-11%, that's your GDP growth, and you have a shift in the consumption basket. Then the second point you made about leveraging, which is that there is a advancement of consumption that's happening because people are spending their future income like we never did before. I've never spent my future income. Large part you may have never spent it, but the 20 and 30 somethings in your office are spending their future income, right? So you're bringing forward. That's what America did in the 80s and 90s, right? So that's the second thing that's at play, which is why discretionary is doing a whole lot better, because discretionary is where you can spend your future income.
An Indian can certainly buy a phone worth 80,000. I mean, even though it's difficult
cars,
to justify.
And the charm about this is that it actually then boosts staple consumption also, because once you have spent your future income buying discretionary, you've spared your current income to buy staples.
I got an SMS from one of the finance companies a couple of days ago. Come and celebrate your Diwali and you can pay on EMI.
Sorry,
so I said, you can pay on EMI, which means that you go for a Diwali dinner, you can pay the dinner on EMI. So,
so it is going to get a bit crazy in the end. We have not gotten there because consumer debt to GDP in India is only 15%. So we have a way to go, and in our report we projected to go to 25%, which is still a far cry from where China is and where US are. Of course, we are not at the same per capita income, but we'll get there. So that's what's happening on consumption. That's why you get these mixed signals. I think they will get more and more strong as you go forward because it will spread into various other consumers as well.
We would love to have a longer discussion.
Just one last question. I wanted to ask you about, is it become a fad that, a lot of brokerages are coming out with these 10-year projections now, whether it's for companies, whether it's for the macros. And when I read your report, not as, please don't take offense, but I was reminded of the BRICS report in 2001, which also made a 10-year projection. In fact, they call the next decade belonging to the BRICS. I just want to know how clients take to such long-term projections, because for investors, it's really a 3 to 5 year cycle when it comes to calculating their returns. So what do they make of these 10-year projections?
So again, with no offense to the media focuses on the headline conclusions. What we are doing in this report is to provide a framework to think.
Okay.
because unless you provide that framework, you don't know how to pick the stocks in your portfolio. So really the purpose of the report is framework to think and not really make those 10-year forecasts, and of course it grabs the limelight, which is collateral damage or gain, as we would want to look at it, of the report, because that is the ultimate conclusion of the framework. But it is basically the framework to think.
Okay, so now if let's say we align with your thought, which is that India is going to grow, earnings will make a comeback, we will start leveraging more. What themes one should bet on? To keep it very simple, I mean, just for an ordinary layman.
Buy financials, buy consumption.
Okay.
Okay, discretionary consumption looks really good. Staple stocks look expensive, save for a couple. Be very sensitive to valuations there, because if the starting point of valuations are high, you don't make money on stocks. Because remember, we're not buying companies. And this is no comment on the companies in the space. The companies are really good. It's about the valuations. I think financials are still okay. A lot of private sector financials, I think, trade at very reasonable valuations for the type of return on equity they produce and the growth that they're likely to produce. In financials, actually, they have an additional tailwind, which is that the public sector is going to give them share.
You're getting market share.
Yeah, so you got 10-12% nominal growth, plus you're grabbing 3% market share every year from the public sector, so you're growing 15%. That's a very good number. If you have a company that can grow 15% for 5 years, and is trading at 3 times book, I think you're set up for good
that
returns.
logic in insurance as well, because insurance is now a sector.
Yeah.
And again, it was only LIC a couple of years ago. The sector is growing.
Same thing. But again, be sensitive to the valuations, because I don't think you can keep that aside. After all, we are buying stocks, not companies. So in that space, the entire asset manager space, the brokerages, the insurance companies, the private sector banks, the NBFCs, I think are all set up in a very sweet spot. And then you have discretionary consumption, which includes autos, which includes household effects, which includes household goods, and it includes other form of discretionary consumption, which may or may not have been touched in the report for lack of coverage. But things like entertainment, education, I think all these spaces are going to see pretty strong growth in the next 5-10 years.
It's rare that you see competition talking great about competition. So Ridham is saying that look, the sector is doing well. I am not listed. My counterparts are going by those stocks.
Charles Schwab listed in 1989. Take a guess. Take a guess how much the stock was up by the end of 1999 in 10 years.
10 years.
Anything
I
listed
know.
during that
500x.
period. And that must have been the
500x.
average. That must have been the average, because a lot of stocks did that.
In
during
2013
that
and 14,
5x,
Motilal
6x.
Oswal,
No,
Edelweiss.
500x, Tanvi, not
Oh,
5x.
500x. Oh, I'm sorry. I heard. Okay, that's
Okay.
humongous.
Really appreciate your time. These
I'm
numbers, when you look at it, they sound
sorry.
like
Nothing can beat
projections.
that.